Hello, everyone. It is good to be back. I want to take a break from the typical educational type of content. I like to mix it up a little bit, and we're going to dive into psychology. In this series, if it is, I don't know if it'll become a series, but I think it will. We're going to call this series Why We Do What We Do with Money, because money looks like numbers on the surface, although most of our decisions around it come from memory, comparison, and expectation. Across different centuries and economies, people repeat most of the same behaviors with money. And in this series, we're going to dive deeper on that and talk about why we do what we do with money. Money is behavior. We live in a time where almost any financial concept can be learned quickly. You can look up how an index fund works, understand retirement accounts, have AI teach you about taxes, even run projections on your phone while sitting on the couch. And with that much information available, it would seem reasonable to expect financial decisions to come easier once the numbers are clear. And yet, people can react very differently to the same situation. The same opportunity can feel reassuring to one, yet unsettling to another, even when the facts are identical. Now, what would explain this? Well, money is processed by the mind before it is processed by the calculator or what you see. A financial decision carries a feeling alongside the numbers, and that feeling tends to lead the way. And there's a historical example that shows this clearly. After the Great Depression, many Americans stayed away from the stock market entirely for the rest of their lives. Not for a few years, for decades. They kept their savings in cash, bank deposits, under the mattress, all while businesses were growing and stocks were compounding through the 1950s and 60s. I mean, they knew about the market, and by then, newspapers printed stock prices daily. There were financial advisors, and the information was out there. But what stayed with them was the experience. They watched banks literally fail, and they had seen neighbors lose their jobs overnight, which then brought in this fragile feeling about money. Their brain stored that event as danger. I mean, the Great Depression, there's a reason why it's called the Great Depression. It was very great. And if you were working around then, it messed with you. Psychologists later put a name to this and called it loss aversion. And the Great Depression was, of course, an extreme example, but the idea is a loss sticks with you much more than a gain. Losing $100 feels twice as worse than gaining $100 feels good. We don't like losing money because it's painful. And the mind holds on to the memory of pain and quietly tries to make you never experience it again. And we see this a lot in sports betting. Losses hurt much more than winning feels good. We also saw this in 2008, the great financial crisis. There's only two greats, the Great Depression and the Great Financial Crisis. And a very similar behavior was involved in 2008. Those that went through 2008 still talk about it today. And quite a few people never invested back into the stock market. And from the outside, holding cash through one of the strongest economic expansions in history looks very cautious, very conservative. From inside their experience, it looked sensible. Many years apart, very similar behavior. And you even see smaller versions of this today. Someone who lived through a layoff early in life might keep a large cash reserve even when their career has restabilized. Someone who watched their parents struggle with debt wants to get their mortgage paid off as soon as possible, regardless of the rate. The brain is just doing what it's designed to do, to keep you safe. And another piece of this is simply the discomfort of not knowing. We hate uncertainty. When outcomes feel unclear, the mind wants closure. Acting, even when the action isn't optimal, can feel calming because it ends the waiting. Psychologists sometimes call this uncertainty avoidance. You're really trying to settle a feeling. And once you start seeing money this way, a lot of behavior starts to make sense. People's spending decisions, their behavior can be almost like a story or memories that they're carrying into present decisions. It's important to go through these feelings and understand why you might be feeling this way around a certain financial decision or why maybe it's important to keep an open mind, knowing that you might have some subconscious baggage driving financial decisions. Spreadsheets matter, seeing projections matter. It can help drive confidence, but at the end of the day, as I mentioned earlier, that feeling tends to lead the way initially. So having this awareness might allow you to step back and not act right away on that first feeling or even that second feeling, but rather think through why you might be feeling this way, talk to someone about it, and make the best decision for yourself. Because money is just tied to security, and security sits pretty deep in the human mind.